Well, the capital structure of the firm does not change the value of the firm. Whether the firm was financed completely by equity or by equity and debt, in a sense, it didn't change the value of the firm. Now, it does change the allocation between equity and debt, but that's actually it. But cash flows don't change. So the more general setting that is described by Monty and Miller, and so here you see that this molds under what we call the perfect capital market conditions. And these are that, well, investors can trade at the same set of securities at competitive prices. This is not a problem. Typically, we can trade assets, so that's a general condition. But then, the very important assumption that they make here is that there are no taxes, no transaction costs, no issuance costs. And no transaction costs, well, in large firms, the transaction costs are relatively relatively small. If I invest and I want to buy an ETF at my broker, then it costs me something. I have to pay for it. And the fees, well, relative to the amount that I want to invest, are still relatively high. For smaller investors, there are still transaction costs. For very large firms, the transaction costs are proportionally relatively low. So, in a sense, transaction costs are not so important. But the taxes, they are very important. And taxes can be around 35%. Transaction costs are a lot smaller than that. So it's really the taxes that are very important. And so this is one of the most important assumptions that is made, that is not conforming with what is happening in reality. Because in reality, we do pay taxes. We pay a lot of taxes. So this is something that we have to worry about, in the sense that here we see that these assumptions lead to simplification of the real world, but we have to lift the no taxes assumption to arrive to what is going on in reality. So they also assume that the firm's financing decision does not have an impact on the cash flows, and it doesn't reveal any new information. That assumption is not, well, it's also like that more or less in reality. So that's not a very strong assumption that they made. The strongest assumption is no taxes. Okay. So whatever we establish in this chapter, you have to bear in mind that taxes are not taken into account. So this is a very strong assumption that we still have to overcome to see what's going on in reality. So as I said, Monty or proposition 1. So they say in a perfect capital market, the total value of the firm is equal to the market value of the total cash flows generated by the assets, and is not affected by the choice of capital structure. So it does not depend on the proportion of equity and debt. So this is very important, that under perfect capital markets, the value of the firm stays the same no matter what capital structure is held. And so, when there are no taxes, you see that the cash flows that are paid out by a project don't really depend on whether the firm has debt or equity. So we saw that by the law of money price, the value must be the same as the total market value. So the value of the equity and debt should be the same as the total market value of the firm. So that's why the value of the firm won't change when you change the proportion of equity and debt. And this leads us, with that, we arrive at a different kind of question. So some people may say that, well, I am investing in a firm and it has invest in a full equity firm, how can I change the leverage of my investment? And this is what we call homemade leverage. It means that you as an investor cannot change the capital structure of a firm. You have to take it as it is. But assume that you want to change the leverage in your investment, and you can do so by taking debt. So if you're investing in a full equity firm, but you would prefer to invest in a leverage firm, you could take on debt. You could add a personal debt to that investment to obtain a leveraged investment without changing the capital structure of the firm, because you won't be able to do that. In a sense, here we show as well, it doesn't matter what the capital structure of the firm is. You actually don't have to change it because the value of the firm doesn't change. And again, under the condition of perfect capital markets. So still under the conditions that there are no taxes. So homemade leverage is when investors use leverage in their own portfolio. So I use a debt in my own portfolio to try and change the leverage of my investment without changing the capital structure of the firm. And so here, what Jackie Miller they showed that if you want to have another capital structure, the one that the firm has chosen, you can do so by adjusting it in your own portfolio and actually achieve the same result. So you first assume that you use no leverage and you create an all-equity firm. So this means no debt. Suppose that you have an investor who would want to hold leverage equity. So the firm that he invests in has no equity, but he would prefer to have an investment with leverage equity. What he can do is add debt to his own portfolio. So you have unleveraged equity. So this is my investment and the initial project. The investor can take on a margin loan. Suppose, as we did in our first example, where we had 50% debt here. So he takes $500 loan. We assume here that he's paying the risk-free rate and it's 5%. So that means that he has to pay back $525 in year one. And so he has this unleveraged equity investment. He adds a loan to that, and then you see that he ends up with the cash flows of the leveraged equity of the firm. So by taking a loan, so initially the investor invested here. This was his initial investment. He said, I don't like full equity. I want a leverage. I want to have, this position. This is what I like. These are actual organs. This is the situation that I like. Well, he can create this by adding a margin loan to leverage equity. So even though the firm is fully financed by equity, if the investor wants, he can recreate the situation of leverage equity by taking the loan. Okay. So he doesn't have to, he cannot change what the firm is doing, but he can make the adjustments in his own portfolio. So again, the Bible law on price value will have to be 500. If we now assume that the firm has debt, but that the investor does not want an investment where there is debt. So he doesn't want leverage equity, he wants the investment unleveraged equity. So then again, what you want to do that, you can have the unlevered equity. So this means that you would have to buy the debt and the leveraged equity to obtain the unlevered equity. Because in the capital markets, if you want equity, and this is what you can buy. If your firm is levered, then this is what you could buy. But if you would also add debt to that, then you can indeed obtain the position that you want, the unlevered equity. So, on the one hand, you could say, why would I want to do this? Because under the circumstances of perfect capital markets, the choice of capital structure does not affect the opportunities available to investors. And moreover, the capital structure has no impact on the value of the firm. So in a sense, there is no need to do this because the value doesn't change, but you can do it. That's the only thing that they want to show here. So it doesn't affect the value of the firm. It doesn't really affect your investment. So in the absence of taxes, there's actually no reason to do this. Again, I added an example where assume we have two firms. In 1 year, the cash flows are 1,400 or 900. So you could say now and in 1 year. So here, the value is 1,400 in the upstate and 900 in the downstate. The firms are identical except for their capital structure. So one firm is unlevered, so it means no debt. So this is a full equity firm. The other firm has borrowed 500, and the equity has a market value of 500. So what does that imply about the value of the levered firm? It will have to be 500 plus 500. It will have to be 1,000. What would that imply if we are in perfect capital markets? It would imply that two companies that generate the same cash flows, with the same expected future cash flows, have a different value. Should not be the case, yes. So they should actually have the same value. So if there is a difference in value, there is an arbitrage. What do you do when you see an arbitrage? You want to make money. How do you make money? You buy low, you sell high. Yes. Buy low, sell. That's always, if you want to invest, you want to buy as cheap as possible and sell as high as possible. Then you're going to make money, right? So here, we're going to buy low. So the lowest priced one is the levered firm. And we sell the unlevered firm. And so that way, we will be able to make a profit of 10. So here, you see that the firm, they hold identical assets. The total value should be the same. However, you see that the unlevered firm is 1,010, whereas the levered firm is worth 1,000. So this is a violation of Money-Annual 1, because the value should be the same. So what you can do here is, here you have the unlevered equity. This is a cash flow that you want to obtain. So you want to obtain the unlevered equity. This is the incoming cash flow. You're going to buy the levered equity that generates these cash flows, and you buy the levered debt. So here, this is what you're doing here is you're buying the levered firm and you're selling the unlevered firm. So here, you're actually buying the levered sell the unlevered firm, and then it can make a risk-free profit of 10. So here it is clear that I am not taking any risk, but I'm making money. This is not something that can continue. This cannot be an equilibrium, so this has to be an arbitrage. I created a portfolio that doesn't cost me anything, but that generates me money. That has to be an arbitrage. So it means here that the pricing is actually wrong, and that both should be priced the same. And in a sense, they will in equilibrium. Okay, another issue I want to address is, so what we're doing here is we're looking at our balance sheet, we're looking at equity and debt. And so here we're going to look at our balance sheet in terms of market value. Not in terms of historical value, but in terms of market value. And so the market value balance sheet, in that balance sheet we represent everything at market value, okay, at the current price. So all the assets and liabilities of the firm will then be included, also like goodwill and all the intangibles, everything that is firm that may even be missing from standard accounting, and the values are quoted at the market prices as the current values, okay, not at the historical cost. So that's one way. And so that's another way of looking at it, especially equity, and it's not always valued as such. So you look the different debts, so the equity, not just the common stock, preferred stock, the warrants, the options. So everything priced at market value. So here you see that if you want to calculate the value of the equity using the market value balance, you have to use the market value of the assets minus the market value of the debts and other obligations and other liabilities. So here are short-term, long-term, and convertible debts. Again, I have a small example here. We assume that our social media app has gone viral and it has 60 million in assets. We plan on splitting the firm into equity, debt, and warrants, and we expect to sell 10 million in debt and 50 million in warrants. The question is, what will the value of equity be in a perfect capital market? Well, if you look at the market value of the equity, the market value of the assets minus the market value of the debt and other liabilities, we see that here the warrants are are part of the other liabilities. So you have the total value, the total market value is 60 million. You have a debt 10 million and the warrants 50 million. So here indeed you have 60 minus 10 minus 15. That should indeed be 35. So the value of the equity should be 35. So you just look at the market value or at equity in terms of the market value as well. Another way of looking, so we're going over our balance sheet. We're looking at our capital structure, and we're seeing what we can do with our debt and equity. What firms have also done is to do recapitalization. They have, for instance, borrowed money to buy back equity. In that way, they are recapitalizing. They are changing the capital structure of the firm. So they borrow money to buy back equity. So here, a firm uses borrowed funds to pay a large, it can be to pay a special dividend,
adjusting the market value?
Yes, so when the market value is relatively low, then you could do that. And why would you do that? If the market value of your shares is relatively low, then of course there's always the possibility that another shareholder or that someone takes over your firm, because your firm is cheap. If you as a firm buy back your own shares, you also signal that, well, your firm is doing well. If you think that it's a good investment. So here we look upon changing the capital structure of the firm by buying back shares. Now, if I go and borrow and buy back shares, it's clear that my capital structure will change. It's clear that my proportion of debt will increase and my proportion of equity will decrease. Let's look at what this does to the firm. So we have Harrison Industries, and they start out from being a full equity and all equity firm, and they work in a perfect capital market. And so they have 50 million shares outstanding, and they're traded at $4 per share. What information does that give us? I have 50 million shares. They are $4 per share. So that means that I have $200 million, and this is my market cap. My market capitalization. That's my market capitalization is the number of shares times the price. So that's the information that I get from the first day. Then we see that they plan to increase the leverage. Well, here, what was the debt? The debt was zero. So what does this imply about the equity? The equity was 200 million. If the value of the, here, it's trading at 200 million, so 500 shares, $4 per share, so this is the market cap, this is the equity. So Harrison plans to increase the leverage, and they're borrowing 80 million, so their debt, they want to make their debt grow to $18 million. And how are they going to do that? They're using the, or what are they going to do with these funds? They're going to use this to buy back 20 million of the outstanding shares. So that means that the number of shares will decrease. And so where here they had 50 million shares, in the end, here they will only have 30 million shares. Okay. So what you see occur here is the first thing is they're actually going to get debt. So they will, if they get debt, then they get cash. They're borrowing money. So on their liability side, they will get the debt, but on their active side, on the active side of the balance sheet, they will get the cash. And then in the second stage, you see that they are going to use the cash to buy back the shares. So if we look at the initial states, we have 200 in assets, 200 in equity. represent by recapitalization. They're going to borrow using the money of the debt to buy back shares. And so from having a full equity firm, they use debt to obtain a leveraged firm, where they have 80 in debt and 120 in equity. So, here we have the extension of our example, and we have 200 million shares. You have 80 million. This is what's equal to the amount of cash that has been raised. So, these liabilities grow. You see that both the assets and the liabilities increased by 80. They were able to buy back 20 million shares, so the amount of shares dropped from 50 million to 30 million. And, because the assets, of course, then decreased by 80%, the debt remains the same, so you see that the equity drops from 200 million to 120 million. And so the share price stays the same. So here you see that Modigliani-Miller's first proposition can actually be used to derive this relationship between leverage and equity cost of capital. And with that, we're going to obtain Modigliani-Miller 2. So Modigliani-Miller 1 is all about the value of the firm. The value of the firm doesn't change no matter what happens to the capital structure. Now what we're interested in is what is the rate, what is the return on leveraged equity, what is the return on assets, what is the return on leveraged equity. And we will see that we can come up with a proposition, and that's going to be proposition 2, where we are a bit more explicit about what is the equity cost of capital, what is the relationship between leverage and the equity cost of capital. For that, especially in Berkeley Marshall, they use some, so they represent E as market value of the equity, D as market value of the debt. With U, they mean the market value of the equity in unleveraged firms, so U represents the unleveraged equity. And A stands for the assets. So in their formula, when they use E and U, so E here represents it in the leverage firm, the equity of the leverage firm. So when we look at Modigliani-Miller 1, we look at the value of the firm. And so we say the value of the firm is the assets. The assets represent the unlevered firm, but the value of the unlevered firm is the same as the value of the levered firm, so equity and debt. So equity represents the levered equity plus the debt is the same as the value of the unlevered firm, is the same as the assets. This is Modigliani-Miller 1 symbolically, you can say. What we now want to obtain is we want to look at the cost of capital. We're not just interested in the value of the firm, but we're interested in the return. You can say in the return on equity. Because what did we see? When you have more leverage, the return on equity changes. The return of the leverage equity changes. Because the risk increases, you need to have a higher return. So where does that come from? And what we want to do is obtain some information about that. What we see is that, well, the return of the unleveraged equity depends on the return on equity and the return on debt, so the return of the leveraged equity and the return of debt, but it's really the proportion proportion of equity and the proportion of debt. So what we want to do is we want to solve for the return on equity, because we're interested in what is the return on the leveraged equity. And so when we rewrite this formula, you see that the return of the leveraged equity is the return on the unleveraged equity, but on top of the return on the leveraged equity, on top of the return on the unleveraged equity, we actually get an extra return. And this extra return that we get, extra return above the risk-free rate, above the return on debt, depends on the proportion of debt equity. The higher the debt, the higher the proportion of debt equity, the higher the return of leveraged equity. So here you see that what is very important to determine the return on leveraged equity is actually the debt equity ratio. This is very important. So it means that how important is your debt for your firm? Well, this will have an impact on the return of the leveraged equity as well. So this gives us Modigliani-Miller proposition 2, where here we're talking about the cost of capital of the leveraged equity. So whereas Modigliani-Miller 1 talks about the value of the firm, Modigliani-Miller 2 talks about the cost of capital of leveraged equity. So Modigliani-Miller value, Modigliani-Miller 1 value, Modigliani-Miller 2 return. Return of what? Return of the leveraged equity. Okay. So here we look at our cost of capital of the leveraged equity that depends on the return of the unleveraged equity, but it will always be higher than the return of the unleveraged equity. Yes. It will be higher than the return of a fully equity, of a full equity firm, because when we introduce debt in our company, we will increase the risk for the equity holder, and so the leveraged equity, the return of the leveraged equity will increase. So if we get back to our example that we used, where we had an all-equity firm, and remember, it's the very first example that I used. We have we had an unleveraged equity, and we have a full equity firm, where we said the risk premium was 10%, the risk-free rate was 5%. So here, the rate was 15%. Then it started to finance its firm with $500 of debt, and the expected return of the debt was 5%. So if now, based on Modigliani-Miller 2, we would have to determine the return on equity, what would we do? The return of the unleveraged equity, this is 15%. Here we have to add the proportion of debt equity. What was the proportion debt equity? Well, it was 500 over 500. So this is just 1. And this times the return of the unleveraged firm. So here, the 15% minus the return on debt. So this is 15 minus 5, so this is 10%. So in total, this gives us 15% plus 10%, so this is 25%. And it is indeed the return of the leveraged equity that we found in the example. So indeed, here we obtain 25%, and it's exactly the return of leveraged equity that we found in the first example, after having added $500 of debt. So we could look at an alternative example where we borrowed 700, and again, the expected return of the unleveraged equity was 15%, and the risk value of 1,000. So sorry, here actually plus. So here we have 700 divided by 300. The return of the unlevered debt is 15% minus 5%. So here you see that this proportion, especially this proportion that is the driver. Right? So here we get 38.33%. It's exactly the result that we obtained in the alternative example as well. So here you see that we can, using Modigliani-Miller 2, we can very quickly obtain the return of leveraged equity. Because it is determined by the return of unleveraged equity, but it will be higher. We require a risk premium, and the risk premium depends on the proportion of the debt equity for real estate. So we still need to go a step further in the sense that we want to determine our weighted average cost of capital, and for an unlevered firm, of course, it's very easy because if it's unlevered, all of the cash flows that are generated go to the shareholder. There is nothing that has to be paid back to the debt holders. So in that sense, the market value, the risk and cost of capital, it's all the same. So the return of the unlevered equity will also be the return of the assets, because everything the firm is making is going straight to the shareholders. So again, here we're looking at a weighted average between the return on equity and the return on debt when the firm is levered. So an unlevered firm, you get everything, but in a leveraged firm, you have to look at the proportion equity and debt. However, what we say that, Modigliani-Miller say that the value is the same. So our return here, the return of the weighted average cost of capital will also have to be the same as the return of the unlevered firm as the return of the assets. So we see that with perfect capital markets, the weighted average cost of capital of the firm is independent of the capital structure, so it doesn't depend on the proportion of equity and debt, but it's equal to the equity cost of capital if it's unlevered, and this matches the cost of capital of the assets. However, we have to take the debt to value ratio into account because this will have an impact on the risk. So what is very important here is it's the following graph. What you see is that, and look first, initially, you could say here on the y-axis, there is no debt. So here you see the cost of capital, and the return on, and here you see the debt to value ratio. When there is no debt, the equity cost of capital is actually lowest. The more debt, as the debt increases, the equity cost of capital increases. Well, when there is no debt, of course, you don't have to pay any interest. But as initially, if you add a bit more debt to your firm, initially the cost of debt stays the same. But at a certain point, the costs begin to increase. And why do you think very remarkable is that the weighted average cost of capital does not change. Flat rate stays the same. I just want to look at one example and then I will go for a break. So we have Honeywell, and it has a debt equity ratio. So the debt equity ratio is 0.5. The current cost of debt is 6.5. So this is the return on debt, and its equity cost of capital is 14%. So this is the return on levered equity. If they issue equity and use the proceeds to repay the debt, this will reduce the debt equity ratio to 0.4. So they want to obtain a new debt equity ratio and make it 0.4. It will lower the debt cost of capital. So here, our return on debt will not be 6.5, but it will only be 7.75. If they do that under perfect capital markets, what impact will the transaction have on equity cost of capital? And what impact will it have on the weighted average cost of capital? Well, this question you can already answer, because you know that the weighted average cost of capital stays the same. So here there is no impact. What will the equity cost of capital be? For that, we have to use $1 2. And we say it's the unlevered plus the debt equity ratio times unlevered minus the return on debt. So here we will have to fill out the unlevered I suppose we're going to change it here. Yes? So you first have to calculate the weighted average cost of capital by taking the proportion of equity and debt. And here it says that the proportion of equity and debt is 0.5. So you could say that debt equity is 1/2. So we represent debt by 1 and equity by 2. So we start out by calculating the weighted average cost of capital, using the return of equity and the return of debt. And so we have 11.5. And so our new cost of equity will be, well, here, the unlevered, which is actually here the weighted average cost of capital, plus, and here this is our new debt equity ratio, and therefore we find new cost of equity of 13.8. And so as we said, the weighted average cost of capital does not change, it remains the same. So you can recalculate it here, where we say my new debt equity, debt over equity is, you can say 4 out of 10, yes. So then you can use this to determine the new weighted average cost of capital, and you see that it is unchanged. Yeah, that is one extension